The following is a presentation of TFNN.
Hello, and welcome to the Options Hour on TFNN. This is Victor Jones, and for the next hour, you'll be listening to everything options, from stock options, futures options, options. We're going to cover everything. And again, just as a quick market update, we obviously have the S&P 500 trading about 1256, down about 1.25 point. We have, obviously the Dow trading at 11,987, down 20 points on the day. So after a kind of a late day rally yesterday to make a move above the 12,000 mark, we've given up a little bit of ground on the Dow, not too much, but obviously that 12,000 number is, it's a pretty big number, and we've made a move below it while we're holding above 126 in the S&P 500. Kind of an interesting divergence there, where you have the S&P 500, which is holding its heavy support area at 1260, and you have the Dow, which has crossed that 12,000 area, which is obviously heavy psychological support, if nothing else, for the Dow. As a quick update on some of the metals out there, silver is up about 5 cents, trading 34.87. And gold, gold obviously up $6, 17.97. What's so interesting about gold here over, maybe the last, I want to call it about a month and a half, as you had this move, obviously, if you all remembered, in the 1920 area, and we sold off to 1600, and quietly, or not so quietly, if you've been watching any financial media, we've made a move off that 1600 level, and now where are we? We are quickly approaching. We are knocking out 800's door, to quote the old song. So the VIX here, we're down about 8 cents on the VIX. Not much action, 29.77. Interestingly enough, we're moving down below the 30 handle in the VIX. And I mean, look, if we look at what we've seen over the last 2 months, last 3 months, it could be expected, right? We made a huge move to the 46 area, sold off to the 28 level before returning again to the 38 on a recent correction. And I mean, the market has continually told us from a volatility standpoint that once we get into these 40 areas, it's very difficult, I think, to sustain that for any long amount of time. And even over, August to September, when we were oscillating between 46 and 32 in terms of the VIX, which is the volatility or fear gauge of the S&P 500, even when we were oscillating there, a sharp move to the upside at 46 or 48 was quickly met with a move back down to 32. So the market, if we look at the relationship, obviously, between volatility and direction, what do we see? Well, the market's rejecting higher volatilities, which, could only mean one thing, that the market is moving in a positive direction. And if we look specifically at what the SPX cash has done, over the last couple of months. We mentioned it in October. I mean, we gained 120 points in the S&P 500, over 1,000 points in the Dow in the month of October before, correcting after October expiration. And but even with that correction, where do we stand? Still sitting here at the 1260 level, which, becomes an ever more important number. I mean, if we take a look back to when we talked maybe a month ago, what did we say? Well, we said we made such a quick move between the 1340 level down to the 1200 level that there wasn't enough time for enough buyers to really be in that area. I mean, there wasn't a lot of, if you want to call it volume, there definitely wasn't a lot of new buyers there in between the 1220 to 1280 level. So, we thought it might be very, very easy for us to pretty much float through that 1220 level to the 1280, and I don't want to say we have a magic 8-ball or anything, but it's interesting the movement that we've seen specifically in the S&P 500. With that, again, we've talked about gold, we've talked about the S&P 500, and we want to talk to you today. 877-927-6648. Give us a call. Let's talk about your positions. I mean, we're sitting right here at the 1260 level. Clearly, there's a lot of questions, and regardless of where the market moves, market direction, we have to be cognizant of delta, directional move. And today we want to talk a little bit later, obviously, about how to position or how to put on positions that are essentially market neutral in terms of direction. But if there ever was an irony in this, you can position market neutral trades to be directional. We can position these different market or delta neutral trades to one side of the market or another, which helps us be a little bit biased to one direction. And we're going to jump into all of that. But in terms of answering those questions, guys, feel free to give us a call at 877-927-6648. We're going to be answering questions all hour. So what we want to quickly, address is, what these positions are. When I talk about a market neutral position, what does that essentially mean? And I want to walk through, two key elements to this overall position, which is an iron condor. And if it sounds, funny or it sounds intimidating, whatever it sounds like, it's a very, very interesting strategy. And I always say this to options traders, so specifically stock traders or people that are just getting into options trading. And they might ask us on the trading desk here, why should I be interested in options? And what I say is, as a doctor, if you only had a scalpel, how efficient of a surgeon could you potentially be? Well, if you only have one tool in the market, and in terms of trading, if you're only trading stock, you have the ability to buy and sell. So specifically, you have just two tools in your arsenal, two tools in your tool bag. If you want to look at it from a carpenter standpoint, but with options, essentially there are 34 recognized strategies out there and a countless number of others that can be custom created. So essentially you're giving yourself 34 to, let's call it 70 different strategies that you have the ability to profit not only in a bullish market, not only in a bearish market, but in a neutral market as well. And I'll take it one step further. Let's double the stakes, if you will. If I'm bullish in an underlying security, and I utilize options, I can essentially position myself so that even if I'm wrong, even if the stock stays where it is, or if the stock, moves against me, in other words, if I'm bullish and it moves down, or if I'm bearish and it moves up, I can position myself in my option strategy to essentially profit, even in cases when I'm wrong. So what we want to talk about today is the two, I think, building blocks to building this larger strategy, which is the iron condor. So today we're going to talk about vertical spreads, both selling put spreads and selling call spreads, and then how they come together at the end of the day to make an iron condor. But again, if you've got topics of your own, ideas of your own, give us a call at 877-927-6648. So let's just look. We're sitting here at a range, and I think there's no greater example when we talk about putting on positions than to talk about the overall market. Because if you've been watching, in some of these 20-point rallies in one direction or another, it doesn't matter if you're the greatest directional picker. It doesn't matter if you're the greatest stock picker in the world. If the market goes against you, your position is going to do the same. So with that, guys, we want to jump into, let's just look at the SPY. And, we say it every time, and we look at it every time, but I think it's so important. The SPY is the ETF that tracks the performance, 1/10 of performance of the SPX. And, when I say 1/10, it's very close. There's dividends that are built in there, as well as ETF expense ratios, so on and so forth. So it may not track, exactly 1/10, but very, very similar. And as an example, the SPY trading 126.30 today, the SPX cash trading 1260.62. So you can see very, very similar in terms of pricing. The SPY, again, $126.30 today. So if we look at potentially, if we're sitting, again, we're sitting right here at a major, I want to call it support level. It's tough to call it support, but you might call it resistance because we're coming from the bottom side of the market. So I'll call it resistance, but essentially we've pinned here for the last couple of days. But if we want to call it a major resistance area, and let's say that the trade assumption, all good traders, all traders, you have to make a trade assumption, right? You have to make a trade assumption. We're sitting right here at what I'll call resistance, and let's say the trade assumption here is that we struggle to break through this resistance, and from that, I, as an options trader, want to understand how I can potentially profit from the overall market kind of stalling here at resistance. And, if you were to look at the SPY and the options chains, you have a couple of different options. One is November. But, November has about 10 days to expiration. And, when you typically, you might talk to our trade desk, you might talk to any option trader, and you say, the first thing I need help with is selecting the strike, selecting the series for which I should participate. And, what you'll often see is in terms of selling options, which is what we're going to discuss here today, when you're selling options, there's something called time decay. So essentially, options decay in value, over time. So if we were to look at, for instance, in November, there's a call, and the call is for 128. So currently the spiders are trading at 126. This call gives you the right to buy the spiders at 128. Well, why would and that option is trading at about $1.25. Well, why would anyone pay money for the right to buy something at higher than its current price? Well, the idea is that there's some time value associated with it. There's still 10 days in the market, and there's still 10 days of potential to be trading well above 128, and therefore profit on an investment at $1.25. So what you're seeing there is extrinsic value or time value in that option. So basically, as you get closer to expiration, that value comes out of the option until the 128 on the day of expiration is going to essentially be, at 5 cents or no bid at 5 cents, basically worthless. So from now until then, in those 10 days, you're going to consistently see, if there were no movement, you would just see movement or value eroding from that option. And again, that's assuming that there's no directional movement here. So why is that concept so important? Well, if you look at options, essentially, there's two things you can do with options. You can either buy them or sell them. And obviously you can put those different combinations together, calls, puts, buying and selling, to make some very interesting positions, and we're going to talk about exactly how to do that. But, from that perspective, if you can buy them, and that underlying or that derivative asset that you own is essentially always decaying in value, it's a race against time, if you want to call it that. I mean, essentially you're fighting time. You know that each day that erodes is going to take just a little bit of money out of your pocket, so you have to have directional move in order to profit. You have to have a directional move in your direction, or at least a favorable volatility move in your direction, in order to be profitable. On the flip side, right, if we are selling options, if we're sellers of options, what does that allow you to do? Well, essentially, given no movement at all, you can be profitable, because that derivative itself, in its function, is designed to be profitable for the seller, because it's going to erode in some of that time value. And I hope some of this, this information, as we break it down, we get so many people that come in and they say, options were a scary thing, or options were, something I didn't totally understand until we were able to talk to the ThinkorSwim trade desk and kind of break it down in terms that I think are easy for everyone to understand. Whether you've been trading them for a long time or not, once you break these things down, it tends to be a pretty interesting concept. Again, I'll take a quick break here. We're at 11:20 here on the Central Coast. We're in the heart of Chicago here. If you have any questions, guys, give us a call at 877-927-6648. So going on with what we were discussing, if the trade assumption here is that the overall market will stall here at resistance, well, we've got a couple of things to select, and one is November expiration that has 10 days. The next is this December expiration or DECE expiration with 38 days, and what you'll notice, or what mathematicians have noticed historically, is that options decay fastest in the last 45 days of their life cycle. So if you are looking to potentially take advantage of something where you're selling options or net short options, the last 45 days is where you'll potentially profit the fastest, quote unquote, from the decay of that time value of the option. So going further out into, let's say, January, February, March, while there are cases and strategies that do support doing something like that, you're essentially, when you're selling options, you're not getting, let's say, the bang for your buck, so to speak, because the time premium built into those are essentially going to hang around, if you want to call it, or linger until that last 45 days where they create exponentially faster. So essentially, when we look at potentially, assembling our position, we're looking for that kind of sweet spot inside of that 45 days to expiration. In December, with 38 days to go, presents probably the maximum opportunity here to measure the risk-to-reward scenario. We can get a little bit farther away from the market. You'll see what I mean here in a moment, and we can still take in some premium for the risk that we're taking on. So that said, we will skip the November options. We're going to look directly at the December options and what opportunities that potentially provides, again, given the hypothetical that this is your trade assumption. And we're going to walk through both scenarios here just so that everyone knows. So in the ThinkorSwim software, if you happen to be, let's say, lucky enough to be using it, you get some extra information here. And you get not only implied volatility, but you also receive probability of expiration. And so in terms of selling options, let's look at this number as well. If I'll scroll down here for everyone to see, we're currently trading, again, 126.5, we'll call it for ease of math. And the probability of expiration of the 131 call, the December 131 call, is, let's call it 30%. There's literally a 30% chance that we begin trading, that we expire above 131. So, again, let's look at it from the buy and sell side. If I'm a buyer of that option, there's a 30% chance that it's actually in the money at expiration. If I'm a seller of that option, flip the number on its head, and you'll see that you actually, if as a seller of the option, you have a 70% chance that it expires worthless. If I'm selling something to open a position, clearly that's always the objective, to get that underlying asset trading at zero. So let's break it down. If I'm a buyer at 30%, or should I be a seller at 70%? We'll clearly have a little bit higher probability of success on the sell side. But why is that? Well, as a buyer, what's my upside potential? Well, theoretically, it's unlimited, right? I could buy this call at $1.70, and the spiders could theoretically be trading at an infinitesimal price to the upside. Is it probable in a large base index that it would be trading significantly above that number? Maybe not. Obviously, just depends on in most cases, the political and economic environment. But what's the probabilities then? What's basically my upside if I'm a seller of this option? Well, I'm never going to get more. If I'm selling to open a position, I'm never going to get more than what I actually receive for selling it to begin with. So I'm going to take in $1.70, and that is at the most what I can actually receive on this option. As a seller of the 133 call, what does that mean? Well, it means I'm obligated essentially to buy the spiders or the underlying asset at the strike price. In this case, I'm obligated to buy spiders at 131, which could theoretically be trading at any price above that. So my risk theoretically is unlimited. It's managed because it's a broad-based index, and we understand the probabilities of a broad-based indices trading significantly higher than this particular strike price, but theoretically still that risk exists. So in order to take advantage of the decaying time decay, the time decay, and also limit our risk, what could we potentially do? Well, if I were to, let's say, sell this particular option, which is the 131 call, and buy the 132 behind it, what have I essentially done? Well, I've made a vertical spread. That's a vertical call spread that I've just created, a short vertical call spread. And if we look at the individual components, I'm obligated to buy at 131, but I always have the right to sell at 132. So regardless of where the spiders start trading to the upside, I will literally always only have the dollar of risk. Because, again, I'm obligated to buy at 131. I always have the right to sell. I'm obligated to sell at 131. I always have the option to buy at 132. So there's a dollar in between those strike prices. There's a dollar of risk. But does that mean I actually have $1 of risk for every one time I put this spread on? And the answer is no, because essentially I'll take in 35 cents to do that. So $1 minus 35 cents is 65 cents. My real risk every one time I execute this is 65 cents. That also happens to be my probability of profit in a vertical spread. So 65% of the time, I would expect this to actually be, a profitable trade, or we would be trading under my break even in this particular vertical spread. And why is that? Well, the market is essentially just, they understand, the market understands risk and reward just as we understand risk and reward. So if I'm going to pay you 35 cents to do something, you're going to take on, if you're going to get 35 points of edge, you're going to take on 65 points of risk. I mean, that's just the way the market works, and vertical spreads are the best example of that. And so what we have here is something where you take in 35 cents and you're only risking 65 cents. And what are our break-evens? Well, essentially, I'll get 35 cents for this trade, so 131 plus the 35 cents. My break-even is 131.35. So in the spiders where we're trading at 126.30, I have an upside break-even of 131.35. Remember, I'm bullish on this market. I actually think, and this is a trade assumption, I think the market's going down, and yet I have a break-even that's higher than the current market. When you think about stock trading, if you were to sell stock short, which is going to take, a ton more capital, but also immediately when you put on that position, for lack of a better term, you've got a gun to your head. I mean, for 1 penny up, you're making money. At 1 penny down, you're essentially losing money. We've just walked through a scenario where you can put on a trade and your break even is essentially $5 higher than the current market, and you're bearish. I mean, you think the market's going down, so the market can even rally in order for you to actually profit in this particular trade. Again, as we had we just posted in the Tiger Den, and thanks for everyone for watching the screencast and participating in the Tiger Den. Or if you're listening on the radio or Tiger TV, we appreciate it, guys. 877-927-6648. Give us all your questions here today as a quick market wrap up. The S&P is now unchanged on the day. When we started the conversation, we were down about 1.25. We're now we're about 1257.25. The Dow Jones, 11,996. We're down about $11 in the Dow. What's interesting is someone had noted here we made a quick push above 1,800, but again, we're still, 1,800. We made a quick move above 12,000. We're still trading below. We're about 11,998, very close to that 12,000 number. And gold, obviously, we've been keeping our eye on gold today. The gold futures contract made a move above 1,800, now trading at 1802.20, up $11 on the day, which is very, very interesting because you have the equities markets, which are relatively flat. You have the VIX, which was essentially relatively flat, and now we're up about 1%. The VIX is now down 1%. The VIX is 29.57. We're down 28%, down about 1%. In a day where the market essentially is a little bit less scared, and that's basically what that VIX number means. And in a day where the market's a little bit less scared, you're seeing a move in that gold and commodities market. Silver up just a bit, but gold's especially up $11 today. It will take us back into the conversation we're having on risk to reward. Again, we've gone through the call side. We've gone through a bullish scenario, but what can we possibly do on the other end? Well, if we sell the 131, 132, that's $5 higher. Could we do the same thing on the other end? I mean, we're 126 is where we're trading today. If I'm bullish, how do I get myself some breathing room to be right and be wrong, but also be profitable? Well, the 121 put is trading about $2.70. So as a buyer of that put, there's about a 35% chance that we actually expire below that. 35% chance that the option expires in the money. As a seller, 65% chance that I actually, make money as a seller. So if we're selling that vertical spread, the 121.120, I'll take in 20, let's call it 25 cents to do that, which means there's 75 cents on the other end, 75% of the time you would actually be profitable in something like that. So we've gone over two, I think, building blocks or components to essentially what an iron condor is. And if we take both of those two things together and you basically throw them together, you get what's called an iron condor. So if we sell, let's say, the the 131, we're buying the 132 call. We sell the 121 put and buy the 120 put, you would have essentially created an iron condor. And if you're watching on the webcast, you can actually see what this looks like. So if we put all those things together, what are we saying? Well, we're saying that I'm essentially believe to some extent that we're going to stay range bound, or that maybe we'll make a move to the up or downside, but I don't think we'll move outside of these probabilities, the numbers that the market is essentially giving me. So if you put all these things together, that's a four-legged trade, and you're taking in 60 cents to do it, and there's only 40 cents of risk. So you take in 60 cents, you've got 40 cents of risk. And so you basically put on these two different trades together, and it requires no additional margin. And the question would be, well, why is that? Well, the market can't be at two places at once. So it can't go above your call strike and below your put strike at one time. Now, it can move in one direction and then move the other, but it can't expire and both of them be unprofitable. Essentially, one is always going to be a profitable side of the trade. So the market only requires margin on whatever is remaining from the credit to the width between your strikes. In this case, you've got a $1 wide strike and 60-cent credit, so you're only going to be putting up about $40 of margin for every one time you do this trade. And as you can see here, I mean, I'm constructing the trade for everyone, and we'll go out to a probability date of the 18th. So we're going to analyze this up until, actually, let's go to December, We're going to go to December 17th, which is essentially expiration. And you can see that, if I were to put those all together, there's about a 35% chance that we actually expire somewhere in between those. So if, not just saying, hey, there's a 65% that we expire somewhere above this, or 65% chance that we expire somewhere below this, you start cutting that into thirds. So basically, you can arrange or even go farther away out from the market to give yourself a higher and higher probability of success. And so this is, ladies and gentlemen, what we would call something a market neutral trade. I mean, in the world of options, this is essentially delta neutral. If you went X number of strikes up and X number of strikes down and constructed an iron condor, you wouldn't have much delta. Essentially, you're going to have a little bit, but exactly the same. You would have very, very neutral delta there, meaning you don't have a directional bias in the market. And for every dollar we move up, you'd actually start to see negative delta, and for every dollar you move down, you'd actually see positive delta, because your position wants the market to expire right in between all your strikes, exactly in the middle. Now, the question we often get is, you know what, I'd love to put on this position, but I think we're at a very, very pivotal point in the market, and I like a market neutral trade here, but I'm a little bit nervous to the downside. I think there's some risk to the downside, and how do I potentially protect myself to the down or upside? And there's a couple of different ways to do that. One, you can potentially create an uneven iron condor. And what does that mean? Well, if you're selling the 121 put, instead of buying the 120 put behind it, you could potentially buy the 119 put behind it. And what did that do? If you're looking at the webcast, you can see I've basically extended my risk on the downside and shortened up my risk on the upside. So if I, if I create this uneven iron condor, I could potentially lose 2 strikes on the downside, but only the 1 strike on the upside minus the credit. So basically, I've got $40 of risk on the upside and $140 on the downside. So obviously, that just gives you the ability to position yourself, taking a little bit more credit, and position yourself for an upside move if that's really what you were expecting. And you can do that on the downside as well. You can create an uneven iron condor by instead, widening the put strikes. As I've done here, you can widen the call strike. So we sold that 131 and bought the 132 behind it. Instead, you could buy the 133, and essentially you're taking on risk to the upside and expecting to move to the downside. So that's just one way you could create a market-neutral position right around the market, still X strikes up, X strikes down, and position it again for success with the expectation that the market could move or has a higher probability to move in one direction than the other. And the other way, that a lot of traders, a lot of option traders will utilize this underlying position is basically to say, hey, I'm not going to keep, not going to keep the current market right in the middle of this constructed iron condor. I'm going to maybe place my put spread, my short put spread, a little bit closer to the market, which positions myself as a bullish iron condor. Or I'm going to position myself to the upside, which is basically a bearish iron condor. So the closer the market is, or the closer it is to one particular strike or the other, you're essentially positioning yourself for movement in one direction or the other. And so when we talk about, again, it's a bit ironic, but market, directionally biased market, directionally biased, directionally neutral trades. The iron condor, the uneven iron condor, and the unbalanced iron condor these are strategies that are available to you. And I think, especially at heavy support or heavy resistance areas, however you want to look at this, if iron condors are something that you're utilizing, it could be very, very interesting, especially if you have a bias, to potentially adjust the position ever so slightly in order to potentially profit or limit risk on one side versus the other. Again, guys, we're going to take a quick break here. We're about 40 minutes through the hour. We've got about 20 minutes left, and we've covered a lot of good content here in terms of market directional or directionally neutral trades. We've got a couple more we want to talk about as well. Unless you guys have content of your own, feel free to give us a call at 877-927-6648. Again, everyone, 877-927-6648. You're listening to the Option Hour on TFNN. As a quick market update, everyone, we got to keep moving here. Got to keep moving at 12:58 even. We're up about 50 cents, so a move of about almost $2, $1.75 since we began the show. To the upside, we began $1.25 down. We're up now 50 to 3/4 of a dollar to the upside. The Dow Jones, interestingly enough, where are we sitting? Right at 12,000. I mean, we're basically down $7 on the day, and it looks like we're setting up for a quick rally. And we've actually just gained a couple of points. We're now 4 points above 12,000. Interesting, very interesting level. And what you're also seeing, though, notice the divergence as the market is approaching this 1260 level in the futures. You're also seeing a rally above the 12,000 level in the Dow. Lastly, gold 1801.30 at 1020, and silver, as we have to keep our eyes on silver, tends to be that high flyer, very, very volatile relative to the other metals. $35.19 today, up 35 cents on the day. As a quick update on what other directionally neutral strategies are on it. I mean, we have talked about it ad nauseum maybe over the last 4 weeks or so, but calendar spreads, I mean, and you can talk about it as many times as you want, because essentially the market is giving you increased opportunities to utilize a calendar as volatility fluctuates. I mean, if we're at a low point in terms of volatility, and I'll bring up the VIX, which is 29.51, down 34 cents, so starting to accelerate a little bit in terms of the VIX calculation there. But basically, as the market or as volatility is basing, these can present opportunities to go long volatility or go long Vega, even in markets which you feel are advancing. I mean, if the overall market increases in volatility, you tend to see somewhat of a correlation in underlying securities as well. So as this market is basing here around 24, 26, it could be interesting if the trade assumption is that we'll stay relatively high volatility versus level shifting down to the 20 to 26 area. Well, basically, I should say 16 to 22. I mean, before we made this move to the 26 to 40 area, the level that we were at was 18 to 22 in terms of the VIX. So if the assumption is we will continue in these relatively high volatile areas throughout the end of the year, as we base towards 29 to 26 level, long volatility positions become a little bit more attractive. And as we get a little bit higher, as we get closer, if we are to have a little bit of a contraction in the equities market and an expansion in volatility, as we approach that 40, 42, 44 area even, I think it's more likely that we see an expansion to 38, that we start to look at potentially selling volatility. And how do you sell volatility? Well, you sell options. You could look at potentially selling vertical spreads like we talked about, selling iron condors, and to go long volatility, you're essentially net long options. So you're buying those vertical spreads that we talked about, where you just essentially flip buying the leg you're buying to the leg you're selling and vice versa. But let's talk about, again, the calendar spread and essentially what that does for you. So if, again, we stay in the spiders, the S&P at the 126 level, if I right-click on the call side and I bring up an actual calendar spread, you'll see it's going to cost us about 50 cents for an at-the-money calendar at 126 in December. And if I bring that up, or if I'm analyzing essentially what that does, you can see it's something very, very similar to an iron condor. I mean, not in terms of construct, but in terms of the risk with the position and in terms of the potential profit as well. I'm spending 50 cents on this, so whenever you're buying something, you can't ever, in terms of risk-defined spreads, you can't lose more than you're actually putting up in terms of capital. So you can see that even if the market moves up or down, I've got a little bit of room to play there in order to actually be profitable. And again, I'll never lose more than 50 cents. And in the iron condor case, we're risking 40 cents. The upside potential here is estimated at about $180. And why do I say estimated? Well, because a calendar spread is so reliant on volatility. I mean, there could be changes in the front month that don't proportionally happen in the back month and vice versa. So you have to be very aware that when you're analyzing a calendar spread, if you have software, again, if you're lucky enough to be using the ThinkorSwim software, if you're utilizing it to trade options, it's a best assumption given the information we have here on volatility today. So again, about $180 is your potential profit for a 50-cent risk. And you can see that it's basically directionally neutral, but you can see that there's this little Vega number down here, and I'm going to set the slices, let's say, to actually the live or current price. Yep. Go ahead and set that to live price. You can see at the live price, which is 126.35, the position, if we put this on, would have Vega of about $2.72 of Vega if you can price it in dollars. So what does that mean? Well, for every 1 percentage point increase in volatility, implied volatility on this underlying security, regardless of movement in the S&P 500, if volatility or the VIX increases by 1%, we would expect to gain $2 and let's call it 72 cents in this position for every one time we had it on. And if it were to move, obviously, in the opposite direction, we would expect to lose $2.72. So in a day like today where we're down 34 cents, we would expect to lose a bit of money just based on volatility alone. So you can see here that we're constructing a position that has positive volatility into, potential base of volatility or of the VIX. And so if you were expecting, let's say, an expansion of volatility, what basically are you expecting? Where you're probably in terms of direction expecting a contraction or a correction in that underlying market. So you might not want to put it right at the current price. You may want to position it one way or the other. So if I look at, again, we're currently trading at 126. Maybe I feel the most likely outcome is a couple strikes to the downside, or I want to position myself to profit if we were to move a couple strikes to the downside. I'll right-click. I'll go to Buy Calendar, and you can see the price here is relatively the same. It's going to cost me 49 cents. You can see what's happened. Here's the current price at 126, and our peak profit point, if you will, and that $180, it's really 190 here, is right around the 124 strike, almost exactly at the 124 strike. So you can see, in this case, not only does our volatility assumption hold correct on a downside move, because if we were to see a downside move, we would expect an expansion of volatility, but also directionally speaking, we've positioned ourselves to take advantage of a downside move. So again, even though these different positions, this iron condor and this calendar spread, can be used in a very market neutral sense or market neutral term, they can definitely be utilized to position yourself for an expectation of a move to the upside or a move to the downside. I know we've probably catered our examples to a move to the downside in both of these examples, but I don't think you can doubt that the market has been really knocking on these 126 and 12,000 levels, and I think the market demonstrated before. We made a very, very sharp move above that 1260 level, and we even shot up into the 1293 area. But the market has demonstrated that the buyers are willing to take it higher, and I think to put on a very, very bearish trade at this potential level without giving a little bit of respect to the upside potential, could be risky. Obviously, and with risk comes reward, but if you're someone who's looking at how to take advantage of option strategy, and obviously limit your risk to some extent, these different market directional trades and positioning them in these certain areas can be very, very interesting and very beneficial from a risk standpoint. With that, we're coming up on 15 minutes, or 10 to the hour, so I wanted to go ahead and give everyone a quick market update. We have given up our rally. We're at 1256.50. We're down a buck in the S&P 500. Dow Jones 11,992, down $15. Failed to hold the 12,000 level. Gold 1803.60, still holding the 1800 level at 1230 as the VIX kind of increases. We oscillated the 35 cents down. We're now back up to 28 cents. We are at 29.57, down 28 cents on the day. So we've taken a lot of technical looks at basically what we've seen here in the market. We've taken a lot of technical and probabilistic looks at the market. Kind of interesting to always back that up with a fundamental view, a quick fundamental view here. And Obi-Wan says, thanks, it's not easy talking for 60 minutes, and I completely agree. If you guys want to give us a call, 877-927-6648. But, the interesting thing, Obi-Wan, is the market is giving us a lot to talk about. So, as we kind of play around these 1260 and 12,000 levels, and I know I've said it so many times, but in my opinion, there's no better opportunities than when we're sitting at major support or major resistance areas. Again, risky to take on new positions or add to existing positions here at these levels, because as we all know in technical analysis, if we break a resistance level, it tends to be support. So if you're taking on a short position, it's going to be very, very difficult in a lot of cases when we break a strong psychological number to basically become profitable in that position, unless we do not see confirming volume, which we saw last time we broke 1260. I mean, if we look back just 3-4 days after last expiration, which was 10/27, we broke the number, but unfortunately volume just didn't confirm. Very, very light volume, and the market just didn't respect it. You saw doji the very next day, and the market said, you know what, let's take this down, and you see what happened. Kind of a dark cloud cover, so to speak. It's not consecutive candles, but it's very, very close. So, from a fundamental perspective, very nice, Jan, in the Tiger Den. But from a fundamental perspective, where's some of this uncertainty coming from? Well, you've seen, I hate to even bring it up, the G word, which is Greece, but this was probably cooked into the market. I couldn't even tell you how many months ago, but now you're seeing some rattling in some other Eurozone countries, some other European countries such as Italy, and some items to be addressed there. So a lot of uncertainty there again, and I hate to be the one to bring it up, especially all the mainstream news is just saying, hey, uncertainty in foreign markets or uncertainty in the European markets. And how long have we known about that? It's really not new information to the market. So I hate to see when things are, pinned, or market action, especially major market action, is pinned on something that's essentially been baked into the market for 6 to 8 months, basically. Oil, though, interesting. If we give a quick update on oil, because that, in some ways, the new world currency, we've now made a move above 96. We're trading at 96.21. We're up 66 cents, which is about 2/3% on the day. So, again, crude, a very, very interesting opportunity here. I think, obviously we're approaching an area. 96 is an interesting number, but by no means is it a major resistance number. I think the major resistance here, if you're looking at it from a technical perspective, psychological and otherwise, is going to be right in the 100 area. Now, clearly, we did have a little bit of resistance set through the move there in late April, in early May of 2011, but really I think the psychological number is going to be right around 100. So, if you're looking to obviously make those plays, the opportunity is there in terms of ETFs utilizing some of the very, very similar strategies that we just discussed. If you felt, at a 96 level, from a probability standpoint, that's going to be tough for us to start trading above 100, and we might see a little bit of correction in the market. Clearly, it's going to be difficult to do that. So, with that, everyone, we wanted to quickly talk about the staples in the market that we've seen, at least for the last 10 minutes, the staples in the market that we've been watching over the last couple of months, and obviously one being Netflix. It was kind of the darling child of the market, and kind of this new kind of tech boom, if you want to call it, traded as high as 304 this year and is now down to $91, but presented some interesting opportunity as it traded as low as 78. And from an option perspective, again here, I think the risk really is to the downside. I think you've seen buyers come into this market on a very, very heavy gap on earnings. You base this market essentially based or found a bottom at 110. It really needed to probably correct and reprice itself, and found a little bit of price correction in the 110 level. Upon earnings, you saw that it immediately dropped to that 75 level, and kind of stayed right around there. It wasn't a significant move to this 90 level. It was a move to 74, which gave very, very tight range, which to me, I think, indicates that the market is fairly comfortable with its current pricing. So I do think that there's an interesting opportunity in the DEES options to potentially look at a high probability move to the upside. Again, if you were to just simply look at the if we were to bring up a little bit more strikes for Netflix, you can see that from a probabilistic standpoint that there is about a 30% chance or 70% chance that we actually stay above 80, and you can see the market moved as low as 75. So very, very very, very interesting risk scenario. I mean, it made a low of 75, clearly said that this is kind of our area of support, and has slowly moved up to the 90 area. So I really think there's an interesting opportunity there at that 80 strike for December. You've got to be careful because the Netflix options are about 10 cents wide, 5 cents to 10 cents wide, so you got to be careful and fight for good execution there in that market. Last thing we want to talk about, or not last thing, another high flyer we wanted to talk about was Apple. And Apple trading right at $404.22, up $4.58 on the day, up 1% on the day. The biggest thing about Apple is this 400 level. And if you remember, we've talked about it so many times, but I think it was such a great and interesting insight in what we had been looking at in terms of Apple. You made a move to 420 on RIM earnings, and then you quickly made a move to the 350 area before coming back on the actual announcements of the 4S numbers, both pre-sale and post-launch, to the 426 area, and we have held the 400. Now, don't get me wrong, we violated the number, but we've held it very, very interestingly enough, but we haven't made a move above 410. So I think what's interesting here from a range-bound perspective is you have this established range at about the 385 to 410 level, and hey, what did we talk about essentially for 30 minutes? Basically ways to play a potential range-bound market, and if you're thinking it's going to be difficult, or you're thinking the market obviously is going to make a downturn, you've got to factor that in, and you've got to understand that if we break the 400 level, it's a very critical number in Apple, and maybe just look at nibbling on the upside. Maybe look at, that 410, 415, 420 area, and what potentially you can do in terms of selling call spreads there in that area. It's, again, demonstrated a very, very tight range, and if we see a move to the upside, I think you do see a continuation of the 420 area, but to what extent, I'm not sure. I mean, there's not a lot of catalysts out there to bring us much higher. The last thing I will mention is obviously Starbucks. Starbucks has been in the news only for its recent earnings. It made a very, very interesting move from the 41 level to about the 45 level. And, Green Mountain Roasters, GMCR, also made that interesting move. So coffee and those commodities making a very interesting show in terms, at least the companies, in terms of earnings. With that said, guys, we're going to go ahead and do a quick market wrap-up. We've covered so much ground here, and I appreciate everyone for listening. But we've got 1256 half on the S&P 500, down about $1. And the Dow Jones 11,990, down $17. So a fail here, to hold the 12,000 level, and the VIX 2966, down only 19 cents. Very interesting. Watch the VIX when you have a neutral day in terms of looking for a little bit of an early indication. Again, the 126 level, very interesting to watch, and the E-mini S&P didn't give us a lot to talk about here today, but we were able to cover a lot of market neutral information. Let's take that. Let's trade this week. And guys, be safe, be successful, and we'll talk to you next Tuesday. Thanks, everyone. Have a great week.